If they know that a few months down the line, for example, there's going to be a change in income. Maybe a child has aged out of getting survivor Social Security benefits. The child's going to turn 18 or 19 or whenever the cutoff is, so we know that's a significant income that's going to drop.
Should the lenders be telling these borrowers to miss a couple payments to get in default and to expedite a loan modification, or is that a farce?
That is a myth. That's a good question you asked that, because there's a lot of misconception. Lenders should not be telling people that. I'm not aware that they are doing it. We do have some people claiming they are.
Right.
Now, when we deal with the servicers and lenders, they tell us that they're not stating that. When we tell people that that is a myth, they don't have to wait till they're in default. But there have to be established that there is a default that is going to be coming, because obviously someone who is in good standing is making the payments, and there doesn't seem to be any change in the financial picture so that the payments will be able to be made going forward. The lender has no incentive to modify that loan. So the borrower doesn't have to be in default, but there does need to be some basis to say that default is imminent, because there's going to be a change in financial circumstances.
Most of the cases that you're dealing with, they are in default, though.
Most of our cases, the people come to us and they're already in default. That's right.
Does your lender have to take you to court? Do you have to actually go through a court process to be foreclosed upon?
Absolutely not, and that is a very important question, and people need to understand that Virginia is what's called a non-judicial foreclosure state. Okay. The process is entirely outside of the court, literally. That's where we do the foreclosure, on the steps of the courthouse. Wow. People sign at closing a number of documents, including a deed of trust, and this but this does is it transfers this limited type of equitable ownership into someone called a trustee. And if the borrower stops making payments or otherwise defaults on the mortgage, the lender can notify the trustee, and the trustee is empowered because of this document to sell the property.
Okay. How long does a homeowner have to bring the loan current to stop a foreclosure sale?
Well, in theory, the homeowner can, if they can bring all the payment current even up to the day before. The day before? Certainly. The lender, if the homeowner has the money, I mean, the lender will tell the homeowner in their notices what they need to bring the loan current to reinstate it. And now, one of the problems is that they may actually have accelerated the loan where they want the entire balance paid in. So the lender may not be willing. Yes, they may say, we don't just want you to bring it current. Depends upon what the history is. They may say we want because they do have the right to accelerate and call the whole loan in.
And if they can't bring the whole loan due, how long do they have to wait before selling your home at auction?
Our experience is that the lenders will wait, it's usually 3 to 6 months before that occurs, and it can be longer. There's usually, each loan will be somewhat different, and also the deed of trust will have certain requirements of additional notices that have to be sent to the homeowner. So each case will be slightly different of how long the servicer or lender must wait. And I should point out that that's driven primarily by these contracts, the loan and the deed of trust, not really by statute. The statute in Virginia basically states that if the loan is in default, that the servicer, through the trustee sends a 14-day notice, and if the matter is not resolved at the end of 14 days, and the property is sold on day 14 or day 15 on the courthouse steps.
Wow. In your experience, how often does mortgage fraud play a role in foreclosure, and does your office research that?
Our office does research that, and our experience was that when we first started seeing these cases several years ago, they started coming in, first a trickle, and then it just became like a waterfall of cases. And for the first several years, we would say, our position would be that there was mortgage fraud involved, or there were what we call predatory loans.
Right, about that a lot in the news.
Some people hear the term subprime loans, and that makes it sound nicer. That's what we'd like to say, predatory loans.
Are all subprime loans considered predatory loans?
But when we see the terms, and so in our position, we would say yes, because what we see, for example, are a borrower that might be determined high risk, that doesn't have as much high income, that doesn't have a very good credit history. And so these are borrowers that were given, for example, loans with teaser rates. that might start out at 2% and then reset in 3 years, but the reset rate was always higher than the market rate if they'd have gotten a traditional mortgage. And then they had payment options that were tied to these loans as well, and the borrower could pick the payment, and of course people picked the lowest payment, which in most cases the lowest payment wasn't even paying the interest. So when the loans reset, these people who had been making their payments on time for 2 or 3 years suddenly discovered that not only could they not afford the new payments, but they owed more on the loan than when they started. We had some people with what we call kitchen table closings. The mortgage broker would come to the person's home, and the entire closing took 15 minutes. These were people, in many cases, who didn't speak English as a first language or didn't speak English at all. There was no translator. We saw the qualification documents, the uniform residential loan application, which the broker or the servicer will prepare. The income information and asset information were always inflated. So those were our first wave of foreclosure clients. And of course, because all of those loans were going into foreclosures and the values were falling, then the people who refinanced their homes or into these payment option adjustable rate mortgages suddenly couldn't refinance into a fixed rate loan because there was no more equity. And it was just a ripple effect. But we're seeing now, we're still seeing signs of predatory lending, but now, of course, we're seeing so many people who are the secondary effects because they've lost their job because of the economic downturn.
When you come across those instances and you can see that fraud was committed, does the homeowner have the right to sue the lender? And what is the statute of limitations for that?
Okay, that's a very critical question because they do in theory have rights to sue, but what's important has to do with when these loans reset at 2 years or 3 years. There's a federal law called the Truth in Lending Act that sets forth how the terms of loans are supposed to be disclosed. It requires that disclosures be in a uniform way. The statute of limitations for that, unfortunately, is 1 year. And in cases of a homeowner refinancing, and there's sometimes where the homeowner, certain things have happened that will trigger what's called the right of rescission under the Truth in Lending Act, but that's also only 3 years, all from the date of closing. Fraud in Virginia, if I'm not mistaken, has a 2-year statute of limitations.
Boy, it's not very long.
Not very long. From the time of fraud, or one can sometimes make the argument that it should be extended from the time the fraud is discovered or should have been discovered. But that's tricky because there's the argument, well, the documents were provided, the people signed them. If there was fraud, they should have seen it at the time of closing. So we have, Legal Services has successfully filed cases on behalf of homeowners, and we've resolved them, usually settled. Some have been litigated. But that's critical for people to know. In these predatory loans, most people didn't realize what the problems were until, in many cases, it was actually too late to take an affirmative step. And so people need to be careful also when they're talking to an attorney, that the attorney has expertise in handling consumer issues and foreclosure issues. That's something else that we're seeing is there are some very good and effective litigators that are helping people, and there are other people perhaps with the best of intentions, but are also causing some of the problems.
You mentioned some fraud. Now, should homeowners be aware of these scammers that are offering way out of foreclosure? How many instances is your office coming across of those types?
We see these types of victims, as we call them, these are foreclosure rescue scammers, and we see these victims all the time. People need to be aware, be very wary when someone's promising easy way out, easy solutions. If it sounds too good to be true, it probably is. And again, some clues might be, the first clue is charging upfront fees. That should be a clue right there. And second is promising people results. you can't promise, we can't promise anybody a result. We can help people put together a loan application package. We can talk to the servicer and talk to the negotiator. We can review the client's legal rights and possible legal claims, but we can't promise someone a result. So if someone sits down and says, Mark, I guarantee you I will stop your foreclosure and get you into a modified loan, that's a red flag.
What should someone do if they come across or is a victim of this? Do you have any recommendations?
Yes, we do. Certainly, if they're eligible for our services, they should apply, and we will investigate that. Additionally, Fairfax County has a very good consumer affairs department. They also will make an investigation. They should also consider making a complaint to the State Bureau of Financial Institutions. That agency has actually been very effective in helping us at least recover the fees that people paid to these outfits.
Okay.
In many cases, a simple letter to them will result in the homeowner receiving the fees they paid returned.
Well, that's about all the time we have today. I'd like to thank James Scruggs for being a part of the program today. We really appreciate your insight and expertise, James. Remember, if you have some questions in regards to mortgage loans or like to view this program again, please visit our website at markrigney.org. If you have any questions about foreclosure prevention, please visit the Legal Services of Northern Virginia website at www.lsnv.org. We will read and answer some of your questions on our next show. On behalf of myself and James Scruggs, thank you for watching Mortgage Solutions with Mark Rigney. We will see you next time.